All right. We are the closing print for Monday, January 5, 2026. First full trading day of the new year. And the scoreboard is, well, it's telling a story of dispersion, not consensus.
Total dispersion.
The S&P 500 managed a marginal gain. It closed up just plus 0.06%.
Barely.
The tech-heavy Nasdaq 100, however, slid. It's down 0.11%. But the outlier, the headline winner, was the Dow. It added 0.13%, pushing to a fresh all-time high.
But that down number is a vanity metric, and anyone looking at that green close needs to understand that today was really a choppy mess. It was all engineered by fundamental digestion.
A post-holiday hangover.
Exactly. I mean, the market is struggling with it. We've got the S&P's 16% surge from late last year, still fresh in everyone's memory. But the underlying data is now challenging their whole narrative. The catalyst today was the ISM Manufacturing Index. It printed at 48.3.
And that 48.3 print is so key because it confirms what we've been warning about, this persistent industrial contraction. We're just not seeing the cyclical rebound in manufacturing that we need to confirm that soft landing story.
We're not. And that uncertainty is exactly why the high conviction buyers are on the sidelines. I mean, when you see these conflicting signals, a Dow record high, but, deeply contracting manufacturing traders refuse to commit capital.
They just stop.
They stop. We are fundamentally paused, just waiting for clarity on the 2026 Fed easing cycle. All eyes are on Friday's December jobs report.
So we're in a holding pattern. But underneath the indices, the capital was definitely in motion. We saw a huge sector dispersion. The leader was utilities, driven by that intensifying AI power narrative.
Getting first legs, yeah.
But the big laggard was absolutely mega cap tech. You could just see the institutional desks rebalancing away from those 2025 winners.
And that rebalance is completely confirmed when you look at the liquidity profile.
Yeah.
I mean, we need volume confirmation to trust any directional mood. And today, we just didn't get it.
Not at all.
Consolidated volume clocked in at just 4.19 billion shares. That is trailing the late 2025 average by a pretty wide margin.
Okay, so to put that in perspective, 4.19 billion shares is holiday-thinned volume. It's disjointed. So the key question for the trader has to be, if volume is this thin, how much higher would it need to be for you to trust this as a real floor?
I'd want to see 5.5 billion. Minimum. That would confirm a structural risk-on surge. Today was just a positioning rebalance, a defensive shuffle of chairs, not a true breakout. We watch institutions use the early morning strength in mega-cap tech specifically to fade the rally.
So they sold into the strength.
They sold into it. They were liquidating stale longs, ringing the register on 2025 gains.
And where did that money go? It flowed aggressively into energy and financials.
Yeah.
But what was the catalyst for that specific, really violent pivot into energy?
Geopolitics. Plain and simple. The news of the U.S. military operation in Venezuela, that triggered an immediate and massive short squeeze in the oil complex. That explains those heavy, dark pool blocks moving into oil service names.
Like Schlumberger and Halliburton.
SLB and HAL, exactly. They were the immediate beneficiaries of that unexpected geopolitical risk premium.
Okay, so if that defensive rotation was the theme, we have to look at where momentum failed. Those key reversals we saw into the close. Let's start with the semis. The CES fade was just textbook sell the news.
Oh, it was classic behavioral finance playing out in real time. Both Nvidia and AMD, they opened strong on keynote hype. Reports of price hikes, optimistic roadmaps.
All the good news?
All of it. But they reversed sharply mid-session. Nvidia gave up nearly all its gains to finish near the flat line, down 0.4%. That failure, that signals that even the AI euphoria is finding a temporary price ceiling right here.
In stark contrast, we had another major reversal, but this one was a V recovery. Tesla, TSLA closed up about 4%, right in that $454 to $456 range.
Right.
But you're saying that was a short squeeze, not a structural buy? Why?
Because the price action had no follow-through. It was running solely on the pain of short sellers trying to cover after a brutal Friday. A structural buy needs institutional conviction, it needs volume. The real capital migration today went into SLB and HAL, which closed near their session highs, up 11 and 10%.
That's a buy, the close behavior.
That confirms the rotation has real structural legs, unlike that short-lived jump in Tesla.
So the synthesis for the trader is, the Dow's record is a vanity metric. It obscures the real action. The actionable info is this tech-to-energy pivot. So stay light on high multiple tech.
And you have to watch the bond market. Watch the 10-year yield. If rates start creeping higher again, today's tech fade becomes tomorrow's full-scale liquidation. The risk-reward has just fundamentally changed.
Which brings us to the internals. And here's the paradox of the day. The headline indices were flat, but market breadth was incredibly healthy.
That's the key divergence. The foot soldiers are leading while the generals are retreating. The advanced decline ratio closed at a robust 2.8 to 1 positive. This was not a big tech story.
No, big tech was a drag.
A total drag.
Yeah.
The heavy lifting was done by the S&P 493, your mid-caps, your financials.
And the performance metric confirms that. The Russell 2000 outperformed the Nasdaq by a full 120 basis points today. That's a massive move.
It is, and it tells us the rally is internally healthier than the headlines suggest. We're seeing a rotation with friction. Capital is aggressively moving out of crowded AI plays and into those old economy sectors.
Let's talk about the volatility paradox. The VIX drifted lower to 15.2, down 4%. Zero panic, despite all this messy tech action. Why so calm?
It implies a very specific type of confidence. Confidence that the selling is structural, not emotional. This is a low-vol rotation.
Explain that.
Well, when the VIX drops while the Nasdaq slips, it's a huge tell. If this were a panic, you'd see IV spike. But here, the generals are being trimmed surgically by institutions. Surgical selling is orderly. It actually lowers implied vol.
And the implication of that is profound. It means the market has already priced in jolts tomorrow in the Jobs Friday report.
That's the interpretation. But the key danger signal is still that bearish index divergence. The S&P 500 managed a new intraday high. It touched 6,905. But the Nasdaq 100 completely failed to confirm that move.
That's critical. New highs need tech leadership. The SPX high occurred despite tech. What does that mean for the sustainability of these levels?
It means the market needs big tech to stabilize just to hold this altitude. The foot soldiers can't carry the cap-weighted index forever. You need to watch the 6,880 level on the S&P. If breadth stays positive, but the generals keep retreating and we break 6,880, the index will stall out.
Okay, so let's set the view for Tuesday. Today was a rotational day, not a trend day. Price stayed within the previous week's value area.
Right, so the probability of trend continuation tomorrow is low. I'd say maybe 25%. We're looking at a 75% chance of a range-bound session. You need to prepare for Chop City.
So in Chop City, we trade the edges. Where is the critical line in the sand, especially for options flow and dealer positioning?
The level that matters most is the gamma wall at 5,950 for the S&P, or SPY 595. This is the primary zero gamma level.
The tripwire.
It's the tripwire. The mechanics are simple but violent. If we fail to hold 5,950 on a closing basis, dealers flip short delta. That forces them to sell futures to hedge, and that opens the trapdoor immediately down to 5,880.
So the risk-reward really favors a dip to test liquidity lower rather than a clean breakout.
Exactly. The asymmetric trade here favors long volatility. VIX calls, short-dated put spreads, they become very attractive if we test resistance intraday tomorrow and sell. You're betting on exhaustion at the top of the range.
Let's pivot to the highest conviction setups, the day two plays. It came out of today's rotation. Number one, back to Nvidia. Despite the sector fade, it reclaimed its 50-day moving average on high relative volume.
That reclamation is the key signal. It shows institutional accumulation. NVDA is becoming a sort of safe haven within tech. The play for Tuesday is a high of daybreak. If it gets that momentum, the target is a move toward 155.
And on the cyclical side, JP Chase. JPM had a significant breakout from a 3-week tight flag pattern today.
This is the purest expression of that higher for longer yield bid in financials. The play here is the gap and go. If JPM opens above today's close, that momentum should carry it right into a retest of 257.
So the final strategic mandate for the active trader going into Tuesday, what's the focus?
Don't get chopped up in the middle of the range. Trade the edges of that 5,950 wall. Focus on NDDA for relative growth. It's the best house in a bad neighborhood. And JPM for the structural value rotation. The market is diversifying its engine. Stay liquid.
And keep your eyes peeled tonight. All eyes are on tomorrow's JOLTS report, but before that, we have Jensen Huang's pre-show keynote. We're expecting a fresh wave of AI agentic headlines, and that is going to be the first real test of the tech floor tonight. If that keynote fails to inspire, that NVDA 50-day reclaim could reverse very quickly. We'll see you at the bell.